right, well, welcome to the September Economic Update at Beyond Wealth Advisors. I'm John Cleaver, partner and senior advisor, along with Dennis Bacon.
I'm the Chief Investment Officer at Beyond Wealth Advisors.
Absolutely. So this month's topic, if we needed a theme for it, is inflation is not dead. As hard as the Fed has tried to slow down the economy and ultimately bring down inflation to meet their mandate, the inflation report that came out this morning, inflation came out a little hotter, maybe what it was expected, but still a little hotter than it's been, at about 0.6, which annualizes that out at about a little over 7%. You couple that with last month, which was lower, 0.3%, annualized at about 5 if you combine them over the last 2 months. So maybe not exactly what we're wanting. We'd like to see the economy slow a little bit more. Maybe a little bit disappointing, but we know we're getting there. So how is this playing out across maybe the broader economy?
Okay. Well, over the course of the past 2 months, really the end result is what we were expecting 3 months ago. We're expecting a slowdown to maybe 4% by the end of the year. It's kind of what most people that are not on television talking about. But certainly over the course of the past month or so, we've had a bevy of information that come out. Most of it not favorable. Some of it, though, are some good bright spots. Some big areas are bright spots. The Treasury has risen to about 4.3%, a little bit more than that right now. That's the highest since 2007. So 16 years. The 30-year mortgage rate is up to 7.3. That is the highest since 2000.
Wow.
Now, I think that's an overshoot. I think that'll probably come back down once we get a little bit better inflation news. Crude oil prices are up. We know that every day when we go fill up our gas. It's up to well over $80 a barrel, and gas prices, are depending on where you live, are up quite a bit. The interesting thing is the S&P 500, while earnings are still growing, they're growing at a lower place. They're kind of the earnings are regressing, if you will. And in the month of August, we had almost 5% drop in the S&P 500, and that's the second time this year we've had that. Not unusual, but just to note, that's kind of that's happened. Consumer confidence, while still positive, has been declining. So that's some of the things. And the jobs claims are increasing, and the jobs available are decreasing. So which means that the labor market is loosening up a lot. But on the more positive side, manufacturing in the U.S. improved while still in contraction mode, and Europe is still in contraction. But both of those improved, and China, not only did it improve, it went into the expansion mode. So that's very good. Housing starts and permits, in spite of the high interest rates, actually have improved in the month of August, and almost all aspects of the housing market actually improved during the month of August. So that's pretty interesting. Like I said, a lot of changes there.
Yeah, like you said, a lot of moving parts, a lot of information. I guess if you tried to weigh it out, maybe overall, maybe a little more negative than positive. Certainly, markets reacted the month of August that way, maybe with the exception of energy, which you mentioned. So maybe shifting that a little bit, instead of looking backwards, let's think about what's the prospects going forward, kind of in light of the current landscape.
Well, luckily I have a long perspective on looking at the economy.
Well, we've been saying that for a while.
Yeah, so. But I have a long perspective. I 40 years. But what we look at, what I'm seeing is there are areas of light. There's things that look pretty decent, like you said, housing, energy, manufacturing, which are big areas of the economy.
Absolutely.
Consumer spending has softened some, but what I see is a strong economy with a variety of headwinds, much like we had in the 1980s. Okay, now I remember the 1980s. I was out of college and working back then. Some of y'all probably listening to this weren't even born then. But what we had in the 1980s was what we refer to as a rolling recession. From 1982 through 1993, that 11-year period, 12-year period, every year some sector of the economy was in recession. Whether it was the oil patch in the early 80s, or we had the consumer durables in the late 80s and early 90s. Every year something was in decline in some sector of the economy. I actually kind of see that
Right.
is kind of what I'm seeing, because I see yings and yangs. I see things going up and down, and I really look to that rolling recession. Now, while that sounds bad, it is
Right.
bad for those people who are in the core of that recession. The truth is, the 1980s were one of the top 3 decades in the history of our
Right.
country, with double-digit average returns on the on the stock market every year, on
Right.
average double digits.
Right.
So not all bad, just painful from time to time.
Right. Yeah. And a little spotty from time to time,
Right.
depending on what aspect of the economy you
Right.
might be
Right.
in. So,
So I think really what that comes to is that really stock selection and looking at where
Right.
you need to be. What
Sure.
was there? What the hot dot was last year is probably not the hot dot this year.
right.
That's kind of what we're going to see, and how to, and that's where managers come in.
Sure, absolutely. So, I think we've been saying this for a while. Certainly, the idea of some choppy waters, or, getting bits of bad information,
Mhm.
maybe different bits of information from time to time, but certainly things that maybe aren't as positive. But yet, still, there's enough underlying strength
Mhm.
in certain aspects of the economy and certain markets that we're able to continue to move forward
Right.
and take positive steps, even
Yeah.
though sometimes those headlines maybe
Mhm.
tend to overshadow
Mhm.
what's really happening. So
Yeah.
yeah,
Well, and the one thing I would say, just kind of in summary, is, you know, while I think the mortgages are slightly overweight,
Right.
a 5.5 to 6.5% has historically been the averages.
Right.
So we've been in a low environment.
Pretty spoiled for a while.
We're coming
Yeah.
into an environment that is a lot more normalized and rewards savers as well as
Mhm.
spenders. And
Yeah.
so I think there's actually some really good news in that.
Right.
But I think there are some headwinds out there that I would like to think that it will
Right.
it will normalize in this area where we're at now.
It reminds me that, like, in times like this, the basic fundamental principles of investing, saving, time versus
Mhm.
timing,
Mhm.
diversification,
Mhm.
being proactive, all of those kinds of things really tend to help the investor for
Mhm.
that long-term
Right.
perspective, and not getting caught up in all the
The daily
all the hype.
news.
Yeah, the hype of the daily
Yeah.
news, for sure. So, well, fantastic. So that's a great update, and we'll be back next month with more information. But for now, be sure to reach out to your advisor, touch base. It's always a good time towards the end of the
It is.
year
Uh-huh.
to
Yep.
kind of take stock, no pun
Mhm.
intended, but take stock of where you're at, and know what your plan is going into the end of the year. And certainly we'll be looking forward to those conversations and
Mhm.
meetings in the weeks and months ahead.
And I look forward to you guys all going out and have a wonderful fall. Enjoy
Yeah.
the beautiful weather. It's my favorite time of year.
Absolutely. Thank you.